The story begins in San Francisco, the beating heart of technology and innovation, where a company emerged with an audacious vision to interpret the physical world through data. That company is Samsara Inc., a name now synonymous with the digitization of industrial reality. Samsara is an Internet of Things, IoT, and artificial intelligence AI enterprise that connects industrial operations, from fleets of trucks and heavy machinery to construction sites, warehouses, and energy plants. Its platform translates real-world physical activities into digital information, helping clients make data-driven decisions that increase safety, productivity, and efficiency. The company's ambition is nothing short of revolutionary: to turn the global industrial ecosystem into one vast intelligent network. The journey began in 2015 when MIT graduates Sanjit Biswas and John Bickett founded the company. They observed that billions of data points produced daily in industrial operations were being lost, never captured, analyzed, or utilized. Their goal was to change that. By embedding IoT sensors into the physical infrastructure of industries and analyzing the resulting streams of data through AI, they believed they could rewire how industries function in real time. By December 15, 2021, just 6 years after its founding, Samsara went public on the New York Stock Exchange under the ticker IoT. The market reaction was explosive. Investors viewed the listing as a defining moment for industrial digitalization, the bridging of the physical and digital worlds. Samsara wasn't just another tech company, it was a signal that the next industrial revolution had begun. In the years that followed, growth was meteoric. In 2023, revenue reached roughly $900 million. By 2024, it had climbed to about $1.2 billion, marking an increase of more than 30% in just a single year. But beneath that headline number lay a mystery. Despite this relentless growth, Samsara remained unprofitable. Its net loss, while reduced to around $150 million, persisted year after year. Ordinarily, companies at this stage of maturity begin to display operational leverage, meaning fixed costs decline relative to revenue, allowing profits to emerge. Yet Samsara defied this pattern. The company's cost base grew almost in lockstep with its revenue, creating a paradoxical situation. The faster it expanded, the further profitability seemed to drift away. The explanation lies in its business architecture, which is divided into 3 interdependent but conflicting revenue streams. First, the hardware segment, consisting of IoT devices such as cameras, sensors, and telematics gateways installed on vehicles and equipment, generates upfront sales but thin margins. Second, the subscription-based software segment, the core of its recurring revenue model, offers cloud analytics, safety dashboards, and automated reporting tools. This segment delivers long-term stability but scales more slowly. Third, the AI analytics segment uses massive datasets gathered from connected devices to predict maintenance failures, optimize logistics, and prevent accidents. It has high value but remains expensive to maintain due to heavy R&D and data infrastructure costs. Together, these segments create a tug-of-war between growth and profitability. The hardware drives expansion but limits margins, while software and AI bring profitability potential but require heavy ongoing investment. In August 2025, Samsara announced its Q2 fiscal year 2026 earnings. Annual recurring revenue ARR had surged to approximately $1.6 billion, up roughly 30% year over year. At first glance, it was a stunning achievement. Yet when analysts looked closer, they found details that didn't quite add up. The company revealed it had added 17 new large customers, each generating over $1 million in annual recurring revenue. However, it disclosed no information about who these clients were, what sectors they operated in, how long their contracts lasted, or how often they renewed. This was unusual. Most publicly traded SaaS companies publish at least partial client concentration data to help investors gauge risk exposure. Instead, Samsara merely stated that customers spending over $1 million now accounted for 59% of total revenue, an extraordinary level of dependence on a small customer base. In a healthy, diversified company, no single group of clients should account for such a dominant portion of revenue. High concentration can amplify volatility. One major client's exit can erase an entire quarter's growth. The absence of transparency around this issue left analysts uneasy. Was Samsara's growth being driven by a narrow band of large enterprise contracts that could disappear just as quickly as they appeared? Then came another surprising turn. In September 2025, Samsara lost a patent dispute against its competitor, Motive Technologies. The U.S. Federal Trade Commission ruled that Samsara had infringed on Motive's intellectual property. Typically, a ruling like this would trigger investor panic, stock price declines, and a formal public statement addressing the matter. But Samsara reacted differently. Instead of damage control, it immediately unveiled an expansion of its AI-powered safety platform, a move so swift and polished it almost seemed premeditated. The contrast was striking. While most companies would go silent and regroup after such a loss, Samsara flooded the news cycle with innovation headlines. This created two opposing interpretations. Some hailed the move as a display of resilience, the hallmark of a company undeterred by setbacks. Others suspected it was a calculated distraction, meant to shift focus away from a potentially serious legal and reputational issue. The pattern didn't stop there. On October 21st, 2025, Samsara announced that it had achieved ISO 42001 certification, a global standard for responsible AI governance and data ethics. The recognition placed Samsara among a select group of organizations certified for ethical AI management, a distinction typically reserved for governmental or academic institutions rather than private companies. While the certification strengthened Samsara's image as a responsible technology leader, its timing raised eyebrows. It came precisely as investors were questioning the company's transparency and profitability. Some analysts speculated that this was a strategic credibility maneuver, a way to anchor investor confidence in the company's moral standing while its financial picture remained uncertain. Only 5 days later, on October 16th, Samsara announced yet another headline: a new partnership with Carasoft Technology Corporation to supply its connected operations platform to the U.S. public sector, alongside a software licensing agreement with the state of California. At first, the news appeared to confirm Samsara's expanding influence. Yet, once again, the details were sparse. Government contracts by regulation typically involve public disclosures of bidding processes, contract value, and implementation scope. None of this was shared. To some investors, it seemed less like a solid financial milestone and more like a well-timed publicity move. Taken together, these events reveal a company that thrives on innovation and narrative, but also one that keeps the inner workings of its economics closely guarded. Samsara's story is filled with technical brilliance and visionary leadership, but also with contradictions that puzzle even seasoned analysts. Why does revenue grow exponentially while profit refuses to follow? Why does the company repeatedly disclose good news while withholding key details? And why do major announcements often coincide with potentially negative developments? These are not trivial questions. They go to the heart of Samsara's fundamental valuation. The company stands at the crossroads of extraordinary potential and unresolved uncertainty. Its technology connects the industrial world like never before, but its business model still conceals mysteries investors have yet to unravel. And now, the ValueStir channel invites you, our viewers, to share the stocks or crypto assets you're most curious about, whether listed, unlisted, or upcoming IPOs. Leave your suggestions in the comments below, and we'll investigate and feature them in future episodes. We deeply thank everyone who watches, subscribes, likes, comments, and shares our videos. Your engagement is what keeps this work alive, and we promise to continue delivering even more rigorous, insightful content in return. This was ValueStir.